Welcome back, my awesome people. In today's episode, I will be highlighting the best tool for investing in Canada, and that is the TFSA. The TFSA limit is $7,000 for 2025. This is the same contribution limit increase as in 2024, and the contribution limit increase is based on the level of inflation for the year. In 2023, inflation was very high, so the CRA, the Canada Revenue Agency, justified a $500 increase to $7,000 in 2024, as the contribution room was $6,500 in 2023. However, elevated interest rates have effectively tamed strong inflation, so there was no justification to increase the $7,000 limit for 2025. If you turn 18 years of age in 2025, you will be able to contribute the equivalent of the new contribution limit of $7,000. While it is not much to start with, you will see your total contribution limit increase in every subsequent year as the CRA continues to annually increase the contribution limit. If you were born in 1991 or earlier and were a Canadian resident during and since that period, you can contribute a grand total of $102,000 after the 2025 increase is contemplated. If you were born after 1991, you will have to calculate your total contribution limit, and you can find your personal room contribution capacity on the CRA website under individuals. It is smart to check it out because there can be steep fines for over contributing to your TFSA, which is about 1% per month for any excess amount to your contribution room. Hey, my awesome people. US stocks are on a winning streak, with the S&P 500 hitting over 50 record highs and a year-to-date return exceeding 30%. While uncertainties may arise from Trump policies in the coming year, the strong US dollar and the Nasdaq reaching 20,000 suggest that US stocks continue to be a focal point for investors in 2025. If you're considering US stocks, the Moomoo TFSA account is an excellent choice. Moomoo is an all-in-one trading platform supporting your financial journey. Not only does it offer tax advantages, but Moomoo also helps you minimize costs and maximize returns, potentially saving you up to 90% on US trading fees. Moomoo charges less than 1 cent per share for US stocks and ETFs, with a minimum fee of just US $1.99, which is far lower than the typical $9.99 charged by other brokerages. Plus, Moomoo offers a competitive currency exchange rate of 0.09% plus US dollars, saving you significantly on transaction costs. For example, if you buy 10 shares of Tesla at $400 each, totaling 4,000 USD, you would pay $5.60 USD in transaction fees and $2.10 USD in commission for a total of $7.70 US. In comparison, if you did the same transaction with other brokerages like Wealthsimple or Questrade, it will cost almost double. The more you buy, the more you can save with Moomoo. Now, if you sign up today, you'll receive a $2,000 commission card plus deposit $100 and get $50 in stock cash coupons with up to 50% cash back. If you deposit $2,000, you'll receive $150 in stock cash coupons. And remember, your uninvested funds will earn that impressive 6% APY in cash rebates. So don't miss out on these incredible opportunities. Start your investing journey with Moomoo today. If you've never contributed to a TFSA before, you may have even more room, as any unused contribution limit from previous years is carried forward. And with this in mind, how should you invest in your 2025 TFSA contribution to make the most out of your tax advantage? Historically, stocks have outperformed other asset classes over the long run, making them a prime choice for many investors. However, depending on your risk tolerance and investment style, there are a variety of strategies to consider. The new TFSA contribution room is always a good thing for Canadians. The more you can invest tax-free, the fastest you can compound your money. Regularly contributing to your TFSA, thoughtfully investing, and patiently waiting for your investments to compound is a grand long-term recipe for success. Solid stocks or market-wide exchange-traded funds also known as ETFs, which we love at this channel, like the SPDR S&P 500 ETF Trust, are especially great for maximizing long-term returns when you load up during market corrections. Alternatively, a more balanced approach may suit you, combining lower risk options like GIC investments, bonds, and dividend stocks with higher assets. On another note, interest income is subject to taxation at your marginal tax rate, which is why many investors choose to shelter it within their TFSA. By holding investments like GICs, bonds, or real estate investment trusts like REITs, also known as REITs, in a TFSA, you can generate interest income without worrying about paying tax on the returns. For the ultra-conservative investor, traditional GICs represent the safest option. These investments are designed to protect your principal while guaranteeing interest income. For example, some market-linked GICs allow you to capture a portion, let's say about 70% of the Canadian stock market's returns over a set period, while still ensuring that you get your initial investment back. Bonds are another great way to generate interest income within a TFSA. Although they generally carry less risk than stocks, they can still provide solid returns. Dividend-paying stocks, which again we love at this channel, are a fantastic option for those looking to generate passive income while potentially seeing capital appreciation at the same time. A prime example is TD Bank, ticker symbol TD, a stock that has historically been an outperformer but recently has been underperforming, potentially presenting a great buying opportunity for long-term investors. But for investors seeking simplicity and diversification, a balanced approach may be the way to go for you. One easy to manage option is the iShares Core Balanced ETF portfolio, ticker symbol BAL, which offers an asset allocation of 60% stocks and 40% bonds. This ETF is broadly diversified across different asset classes and regions, and it automatically rebalances to maintain the target allocation. By choosing this balanced ETF, you can invest in a variety of securities without having to worry about managing individual stocks or bonds, allowing you to focus on long-term growth while maintaining a relatively low level of risk, adding that you're likely to average into a position over time. Your TFSA contribution in 2025 is an excellent opportunity to invest tax-free to enhance your returns. Whether you opt for stocks, ETFs, dividend stocks, or a more conservative mix of GICs and bonds, the key is aligning your investments with your risk tolerance and financial goals. By thinking strategically and diversifying your TFSA portfolio, you can make the most of this tax-free vehicle and set yourself up for long-term success. So Jacob Rant, what's your real opinion about the TFSA? Well, my awesome people, here is the bottom line. Put your dividend stocks in your TFSA and your growth stocks in a non-TFSA account. Now, let me tell you why. A TFSA is used to avoid taxes on your investments. If you have a dividend-paying stock, you save the taxes on your dividends, and dividend stocks are seen to be a bit less riskier than growth stocks, because if a company is in trouble, they can easily cut or remove their dividends to stay afloat. Whereas, putting your growth stocks in your TFSA is a bit riskier. Even though you can sell your growth stock without paying capital gains tax, the opposite is also true. What if that growth does not come and it just stays flat for years and years? Guess what? You will be wasting your contribution room. And if for some reason the growth stock goes in the red and you decide to sell, the loss generated will actually be permanently removed from your contribution room and never returned. For example, if I had $1,000 worth of a growth stock in my TFSA and I sell it at $800, that's about a $200 loss, this will be removed from my TFSA and never returned. So I will actually lose $200 from my future contribution rooms. So you pretty much lowered your contribution room. I would much rather pay capital gains tax on a riskier growth stock than to lose TFSA contribution room. Maximizing your TFSA contribution room in 2025 isn't just about contributing the maximum amount. It's also about making smart investment decisions within the account. account. Whether you focus on blue chip stocks, growth stocks, or higher yielding dividend stocks, your goal should be to leverage the tax-free growth advantage that the TFSA provides. By using the right strategy and focusing on long-term gains, you can achieve optimal results within your contribution limits and build substantial wealth over time. So what are your thoughts on the TFSA? What investments do you put in your TFSA? Let us know in the comments below. And don't forget to like and subscribe if this video gave you some value and any insightful content. And remember, my awesome people, just like all the information I mentioned in my videos, assess your risk appetite, always diversify, and please, please, please do your own due diligence, because I am just a clown on YouTube. Stay ranting.